Hey, good day, everyone. Bert Salazar here. Welcome to our webinar. I'm very excited to be here with all of you today because it's going to be a very exciting topic. Today's webinar is going to be on how to achieve a 0% tax bracket in retirement. And this is very important because the vast majority of clients that we engage on a regular basis, when they come in and we ask them the question if they're interested in achieving a tax-free retirement life and a 0% tax bracket in retirement, they're all very excited. The next question they ask is, how do we do this? Because this is something that the vast majority of Americans, as they're approaching retirements, they've never had to deal with any of this. So again, my name is Bert Salazar. We're not going to spend a lot of time on this webinar tonight, but it's going to be very exciting. And there's going to be quality. So I'd rather have quality than quantity. And obviously, we're going to get started in the next few seconds. We do have a number of people that are joining us. But then again, for those of you that are waiting, I don't want to waste your time. So just to give you a little bit of my background, I've been in the financial services industry for the past 28 years. I am a retirement strategist. And I'm also a tax preparer. So a lot of the work that we do for our clients includes tax planning, tax preparation, retirement planning, and many times we have to go as far as doing estate planning for their clients. But tonight is going to be totally different. Tonight is going to be, about achieving a tax-free retirement life and how to divorce the IRS in retirement and do so legally, because obviously there's a big difference between tax avoidance and tax evasion. We want to make certain that we can maximize all the possible tax avoidance techniques that we can use as individuals and as Americans getting and preparing for retirement. But most important, as a tax preparer, I need to be able to do the very best for my clients on an ongoing basis. Now, we do a lot of seminars, and we do webinars, and we also do podcasts. And obviously, we put out a lot of videos of information that is very, very critical for the vast majority of the people that follow us, that engage us, and that give us the opportunity to come into their homes, into their offices to promote, what it is that we do from a retirement planning perspective. So some of the stuff that I'm going to be covering tonight are things that you may have heard from me and that you may have heard from us, but at the end of the day is how do you put it in play? How do you put it together in order to make certain that you and your family, and if you happen to have a business, can maximize the internal rate of return without jeopardizing any type of future benefit that you may have coming to you. So let's start talking a little bit as to how to achieve a 0% tax bracket in retirement. And it starts with understanding, number one, that there are three major tax buckets that all of us are going to have to deal with and that are dealing with today. We have the taxable bucket, we have the tax deferred bucket, and then last, but definitely not least, the tax-free bucket. Now, the taxable bucket is one that most of us understand. That's where your CDs, your savings accounts, your checking accounts, your traditional mutual funds go into. The taxable bucket, every single year, you're going to be receiving a 1099 in which you're going to have to report for tax purposes. So from a taxable standpoint, the taxable bucket is not a very, very good bucket to have. Yet, it is very liquid. So from an emergency standpoint, the taxable bucket is a very important bucket in your arsenal of tax preparation for retirement. Now, the big question is, well, how much money should we keep in the taxable bucket? And the rule of thumb is you should not have more than 6 months of your fixed expenses and even your variable expenses in the taxable bucket. The reason for that is that because of the fact that this bucket is fully taxable, and it is fully taxable every year, you want to keep the least amount of money in that bucket, because at the end of the day, when we do tax audits, we find out that the vast majority of our clients are paying way too much in taxes, and most of them don't even know how to reduce their tax liabilities, which are very, very simple to us to be able to do on behalf of our clients. So again, we want to make certain that we keep that taxable bucket to the bare minimum from a business perspective. Now, the next bucket that we need to deal with is the tax deferred bucket. Now, that bucket, most Americans have a tendency to understand. Most Americans understand. Many of you on this call understand as well. And just about every one of us have investments in the tax deferred bucket. Now, the tax deferred bucket is primarily comprised of your 401ks, your IRAs, your qualified plans, any type of qualified plans that you may have, where the money that goes into this bucket goes in on a pre-tax basis. The money grows tax deferred, but then when you pull the money out, you have to pay taxes on the whole thing. So you have to be very careful how much money you put into the tax deferred bucket. Now, whenever we engage clients for the first time, what is sad to understand is that the vast majority of them have been maxing out their 401ks and their IRAs every single year, thinking, unbeknownst to them, that they're going to be in a lower tax bracket in retirement. But when they come to see us and we do a complete tax-preferred retirement blueprint, then they realize that they may actually be in a much higher tax bracket in retirement than they are during working years. Now, you may ask the question, well, I always hear, Bert, that when we retire, we're going to be in a lower tax bracket than we've ever been in the past because we're no longer generating income. Well, the only thing that changes when you retire is you go from people at work to money at work. So unless you have been a financial failure in your entire life, there's a very high probability that you're going to be either at the same tax bracket that you're in today, or perhaps even a higher tax bracket in retirement. And one of the major reasons for that is you start to lose, your deductions and your exemptions along those lines. So if you're making contributions, to a 401k or to an IRA, once you retire, you're not making contribution to those plans anymore, so you're not taking that tax deduction. What if your home is already paid for? Obviously, there's no tax deduction for the interest that you're paying into your home. What if the house is not paid for, but is almost paid for? That means that the vast majority of mortgage payments that you're now making, they're going primarily toward principal and not toward interest. So your interest deduction is quite diminished as you get closer and closer to retirement. What if you were making charitable contributions to a charity of your choice? Usually, when people retire, they start to slow down in the amount of contributions that they're making to their favorite charity. And they may start giving more of their time as opposed to more of their money. So when you start to factor all of that, even if you were in the same tax bracket, even if your tax bracket did not increase, the fact that you're losing some of these deductions and credits may actually force you into a higher tax bracket at time of retirement. Now, that goes without saying that the other major issue that we have to deal with is, where do you think that taxes are going to be in the future? When you take a look at the national debt today, which is exceeding $21 trillion. When you look at the unfunded liabilities for Social Security, Medicare, Medicare Part D, and that exceeds $114 trillion. Yes, you guys heard me right. I said $114 trillion. Then there's a very, very high probability, if not certainty, that taxes are going to have to be a lot higher in the future. Otherwise, our country is going to go totally bankrupt. Now, under the new tax laws that were signed into law in December of 2017 to take effect January 1 of 2018, taxes over the next 8 years under the Trump administration are going to be pretty much at the third lowest percentage in American history. Other than when taxes first started back in 1913 under the IRS code, and then the second period under the Great Depression of the 1920s and 30s, taxes are a very, very low rate today. Now, we've had taxes in this country as high as 92%. Over the last 50 years, the average tax rate in the United States has been approximately 60%. So taxes can change at any time. Now, the other thing to remember is that under the new tax law, taxes are set to sunset December 31st of 2025. So we actually have an 8-year window in which to maximize all our tax benefits and prepare for that tax Armageddon that we're more than likely going to be receiving at some point in time in the very near future. So it is important to understand how much money you're going to contribute to your tax deferred bucket, the same as we discussed on the taxable bucket. A rule of thumb is to not have more than $600,000 in your tax deferred bucket. And once I get into the tax free bucket, then I'll explain the reasoning behind the $600,000 number. Now, I do have clients that come in that have $1 million, $1.5 million, $2 million in their qualified plans, way too much money. The vast majority of those clients, if not all of them, are going to be in a much, much higher tax bracket in retirement than they are today. Now, also remember, there's a difference between your marginal tax rate and your effective tax rate. The marginal tax rate is that last dollar that you earn. Where does that last dollar fall into the tax map? The effective tax rate takes into consideration all the different brackets that your dollars have gone through and that you have been taxed at the different brackets, and then you're going to add all of those taxes and then divide those by your income, and then you will determine what your effective tax rate is. Our number one goal when we work with clients is to reduce your effective tax rate as close to zero, if not zero, as we possibly can. And that's where tax planning comes into play. Now, the $600,000 is there for a reason. And the second thing to consider is that whenever you're making contributions to a 401k where you're getting a match, your goal should be, from a business perspective, is to put a dollar for dollar contribution up to the match and nothing else. At the very, very worst, do not contribute more than 7% of your income to any type of qualified plan, because you're going to pay the price later on in life. Now, something else that I get asked often from clients, well, Bert, one of the reasons why we have made so much in contributions to our qualified plans over the last 10, 15, 20, 30 years is because of the fact that my accountant has always told me that when I put money away in a qualified plan in this tax deferred bucket, I am saving money on taxes. And I hear that all the time, by the way. I have arguments and discussions with attorneys and CPAs quite often regarding the issues of saving on taxes. When you put money into a tax deferred account, you're not saving anything. You are not saving taxes. Most important, all you're doing is you are pretty much not doing a savings of the tax, but you are postponing the tax. And the worst thing about postponing the tax is that you're postponing the tax liability. And because the tax liability in the future is going to be more than likely extremely high compared to what it is today, then why would you want to postpone a tax liability that you know full well what it is today in order to venture into the hopes that your tax liability may be lower in the future? And unless you've been a financial failure for your entire life, the probability that's going to happen is going to be slim to none. So now let's talk a little bit about the tax-free bucket or the tax-preferred bucket. Now, in the tax-preferred bucket, there are only 4 products under the IRS code that fit into that bucket. And those are your municipal bond funds, your Roth IRAs, your Roth 401ks, and your 7702 plans, which are permanent life insurance plans that enjoy, if done properly, the biggest and the most beneficial code under the IRS code. Now, if you already know that you should not have more than 6 months in the taxable bucket, and you know that the very most that you should have in your tax deferred bucket is approximately $600,000, give or take a few $1,000s, then the vast majority of your assets should go into your tax-free bucket. You know, a question that I get often from clients is, Bert, you know, how much money should I have in the tax-free bucket? And my answer is always the same: as much as you can possibly afford. Because once the money goes into that tax-free bucket, then life is good for all of you, and you're going to be able to mitigate a lot of issues and concerns that the vast majority of Americans that don't do proper planning will not be able to deal with. Now, remember, the goal for all of us in my firm is, you know, to change the financial world one client at a time. And that's what we try to do whenever we do these videos and we do these, you know, webinars and seminars, is, you know, is being able to provide education so all of you would have the ability to live a much better retirement life, full of sound and fury and excitement, you know, until for the rest of your days, and until you decide to, you know, just start doing something different from a business perspective. We do have clients who are retired, and then soon thereafter, or maybe 2 to 3 years later, they get bored of retirement, so they get back to work and they start doing some consulting work and so forth. But at least we want to give you all the leverage. We want to give you all the tools in order for you to minimize your tax liability. Now, as we talk a little bit more about your tax-free bucket, there are some things that you need to be aware of. Number one, your Roth IRAs, your Roth 401ks, and your 7702 plans are the 3 best possible plans that you can have in your overall portfolio, and most important, in your tax-free bucket. Now, there's something known as provisional income calculations. Now, the vast majority of the clients that we engage for the first time have never, ever heard of the word provisional income calculation. And provisional income calculation is a calculation that needs to be done when you start to take Social Security benefits. And the provisional income calculation will determine what percentage of your Social Security benefits will be taxable in retirement. Now, many clients say, well, Bert, why should I be paying taxes on my Social Security benefits if all the contributions that I made through payroll deduction to Social Security was a tax all to itself? And the answer is very simple. If 100% of your income in retirement came from Social Security benefits, then neither you nor your spouse would pay any federal income taxes. So the taxation of your Social Security benefits is not coming from the Social Security benefit itself, but it is coming from all the additional income that you may have to report for tax purposes on that given year that will determine what percentage of your Social Security benefits will be taxed. So your Social Security benefits could receive a 0% tax, so none of the benefits will be taxed. It could be a 50% tax, and therefore 50% of your Social Security benefits may be taxable in retirement, or in the worst case scenario, up to 85% of all your Social Security benefits may also be taxed in retirement. Now, how do we figure what percentage should be taxed? Well, there are a number of calculations that we do on behalf of our clients on a regular basis. Number one, you have to factor in for provisional income calculation all your ordinary income. So any income that you have coming in retirement from, let's say, part-time work that you do, or consulting work where you may be receiving a 1099 from a company. Any withdrawals that you're making from your 401ks, your IRAs, your SEPs, your 403bs, if you happen to be a private sector or public sector employee. Another issue could be a pension. What if you happen to have access to a pension? All of those incomes come in as ordinary income tax, and it will be taxed accordingly. Then you also have to add on your capital gains. So any income that you have coming in from the sale of a stock or the sale of a piece of property in which you're going to be claiming a capital gain for that year will get added on to your provisional income calculation. And last but not least, any income that you may have coming to you from municipal bond funds. Now you may say, you know, Bert, my understanding is that municipal bond funds come in on a federal income tax-free basis if we do it the right way. And the answer is yes. The income from municipal bond funds is generally federal income tax free in nature. But you still have to take the income amount from a municipal bond fund and add it on to the provisional income calculation in order to determine what percentage of your Social Security benefits will be taxed in retirement. So from a financial standpoint, a municipal bond fund is not truly a tax-exempt vehicle. Now, if all of your income came from Roth IRAs, Roth 401ks, and 7702 plans, that income would be totally exempt, not only from federal income taxation, but it will not hinder and or damage your Social Security benefit. So it would not be part of the provisional income calculation. So you could actually have your cake and eat it too if you do it the right way. You could receive your Roth IRAs totally tax-free in retirement. You can receive your Roth 401ks totally tax-free. You can receive income from your 7702 plans totally tax-free. You can receive your Social Security benefits totally tax-free if you do it correctly. And most important, if you do it the right way, under my provisional income calculations and the customized tax-preferred retirement blueprint that we do for each and every one of our clients, you may actually be able to take monies out of your tax-deferred box that would have otherwise been totally taxed to you and your family, and you may even be able to take them on a tax-free basis by maximizing all of your deductions, credits, and exemptions that you may have coming to you under the IRS code. So when it comes to retirement distribution planning, it is very important to have a clear understanding of the relationship between your taxable bucket, your tax-deferred bucket, and your tax-free bucket. So all those things need to be taken into consideration before you get to retirement. Now, if you are a year away from retirement, you can still do some planning. Obviously, it's not going to be as efficient as if you have 5 or 10 years away from retirement. In a perfect world, if you have anywhere between 5 and 10 years away from retirement, then it might very well make sense to start working on a customized tax-preferred retirement blueprint in order to minimize and or alleviate your tax liabilities in retirement. And there are a number of things that need to be done and can be done in order to be able to reduce that potential tax nightmare and that tax Armageddon that all of us are fighting to avoid, but very few of us will do a good job at negating that tax liability. The other issue when it comes to doing proper tax planning in retirement is that the more reportable income that you have under your provisional income calculations, the higher your Medicare premium can be. You see, all those years that most of you were putting money away into your tax-deferred bucket, your IRAs and your 401ks and your deferred comp and so forth, you were thinking or you thought that you were saving money on taxes, only to realize that you were not saving money on taxes. You were postponing the tax and also postponing the tax liability. But because of the fact that you may have no choice, especially when you get into your required minimum distributions, which is at 70 and a half, at the age of 70 and a half, whether you want to or not, you have to start taking money out of the tax deferred bucket, because if you don't, not only are you going to have to pay taxes on the distribution that you should have taken but you didn't take, but you're also going to have to pay a 50% penalty. Yes, once again, you heard me right. So if you have way too much money in that tax deferred bucket, it's going to bring up all of your income, and it's going to increase your Medicare surcharge and your Medicare premium in retirement. So that tax deferred bucket is actually hindering many of the other opportunities that you could have had in retirement. Even by taking too much distribution out of that bucket, you may expediting the taxation of your capital gains to a level that you wouldn't have had in the past if you had done proper planning prior to start taking these distributions in retirement. One of the things that many of my clients, when they come in to visit with me, share is that they want to delay the distribution of their Social Security benefits. And the reason for that is that if your retirement age is 66, let's say, you know, and you delayed that Social Security distribution until age 70, for every year that you delay, you pick up an extra 8%. So, you know, if your retirement age is 66, you can pick up an extra 32 percentage points of Social Security benefits. Now, that could be a good thing, but when we do the Social Security benefit calculations for our clients, not only do we pay attention as to the Social Security benefit, but we pay a lot of attention as to the provisional income calculation impact that Social Security benefit may receive because of the fact that, you know, some of the other assets are not being utilized. Now, remember that in the tax deferred bucket, between the ages of 59 and a half and 70 and a half, you don't have to do anything. You don't have to take money out, or you could take out money one year and not take any money the following year. So you get to pick and choose when you're going to start taking distribution. And what many clients are doing, and many Americans are doing, is that they're delaying that distribution from the tax deferred bucket in order to allow that bucket to continue to grow on a tax deferred basis. But what they fail to realize, as I've said a few times already on this webinar, that when you delay that distribution, you're also delaying the tax impact. And the more money that you have at some point in time in the future out of your tax deferred bucket, the higher tax liability and the bigger the impact that you will have not only on your taxable bucket and your tax deferred bucket, but on your Medicare, on your Social Security benefits, on your qualification for other things. Now, in a perfect world, what I like to do for my clients is have them be in a 0% tax bracket in retirement, to totally divorce the IRS legally from a taxable standpoint, and be able to qualify for Medicaid and food stamps because they show no income in retirement whatsoever. Now, not that our clients and my clients are going to do that, but it's a tremendous leverage that all of you would have. Also, think of it this way. If I can reduce your tax liability, if you can reduce your personal tax liability in retirement by 15, 20, 25%, by 100%, then you don't have to take any type of risk in your investments. You know, there's something that we call eroding factors, and there's something that we call the fatal four, which are the four major fatal things that can happen and that will happen to all of us in retirement. The risk of dying too soon, the risk of living too long, the risk of living with a disability, and last but not least, the risk of living with eroding factors, which come with inflation, taxation, stock market volatility, interest rate volatility, all of these issues that put a tremendous amount of pressure on your assets in retirement. Remember, you've gone from people at work to assets at work. So therefore, now you no longer have the luxury to allow your money, if there's a stock market volatility, to allow it to continue to grow until you're able to pull the money out once the market recovers. If you have to take required minimum distributions because you are at least 70 and a half, you have no choice. The market can go down 10, 15, 20%. You may not have a need for that money, but guess what? You're gonna have to start taking distributions out of your IRAs, your 401ks, and other qualified plans in order to avoid that 50% excise tax and liability in retirement. So again, understanding how those rules of engagement work is very critical, because everything changes when you get into your retirement life. So not only do you have to pay attention to your tax liability, you have to pay attention to your market volatility and the interest rate volatility on your assets, because you're no longer generating assets. So now you're starting to invade many times principal and interest. You're going to have to deal with longevity planning. You don't want to run out of money before you run out of life. Now, the longer you live, the more susceptibility you're going to have to the third area of the fatal four, which is living with a disability. Long-term care has become a major, major issue for most Americans in the United States, and will be so for the next 50 years at least, from a business perspective. So how are you going to be able to mitigate all of those issues? Dying too soon, living too long, living with a disability, living with eroding factors, managing all of the issues of taxation, trying to understand exactly where you're at from a taxable perspective every single year in retirement. If you don't have a chessboard, if you don't have a proper chessboard, how are you going to be able to play chess? How are you going to be able to play your financial chess in retirement? And how are you going to be able to do it adequately, effectively, and efficiently in order to maximize the benefit for yourself, your family, and your business in retirement? Always remember, and this is something I want to leave you all with, that my goal and that of my firm is to kind of help all of you, and I mean all of you, change the way that you see things. Because when you change the way that you see things, the things that you see change. And most important, we want to educate our clients in making certain that you're able to look at your finances through a telescope as opposed to a microscope. Again, thank you so very much for giving me a few minutes of your time. I always get excited when I do these webinars for my clients, because the more information and the more education that we provide, the better all of you are going to be. Because at the end of the day, information without education always, always, always leads to failure. Have a great day, and we'll talk soon.